I always tell investors that it's all about quality stocks, investing in quality stocks, investing in companies whose earnings, profits, cash flows grow in the long run. Then the company becomes more valuable and you will profit by capital gains and growing dividends. But there's a second aspect which is important for successful investing, and that's the valuation of the stock, especially when you buy the stock, and even more important when you make a one-time purchase of a stock, because if you buy a stock and it's overvalued and then there comes a correction and then you will have book losses, and these can last very long, weeks, months, even years, and during this time maybe you lose patience and faith in the company and then you sell the stock and then you realize capital losses, and that's unhappy experience, and I don't wish that to you, and because of that we make this video here. I show you how you can value a stock, how you can calculate fair value of the stock, how you can calculate the expected yield for the next years to come, capital gains including dividends. My name is Thorsten and I'm the founder of this beautiful website here. So first we need some stocks to base our examples on, and I select hot stocks here. Hot stocks, that's not a AMC and GameStop, but it's hot stocks, hot quality stocks. So these are the most the stocks with the most clicks on the watch list on our website. And you see that we have quality stocks here: 3M, Johson, Microsoft, and there are also stocks from outside the United States you might not know, like Fresenius, British American Tobacco should sound familiar to you, Tencent, Novo Nordisk, and SAP, and our ones. You can just visit this site, this page here, it's free for anyone. And we have here 4 columns, and these columns tell you something about the quality of the stock from a long-time investment perspective. You see here the stability of earnings, reported earnings, of operating cash flows, which means how reliable did the company increase its earnings and cash flows in the long run. Then we have here the increase rates, compound annual growth rates. If you combine this, you have a good idea how successful the investment was in the past, but probably will also be in the future. And here you see the years, the yield during each single year, including dividends, split between dividends and capital gains. And we just base our examples on this. So the first one is 3M, and I can just visit the screener here, load the screener, and then I will load 3M, and 3M is the first pre-selected stock always. So this is very nice. And we change the chart layout and go to the valuation tab right here. And this is where you can calculate the fair values of a stock and also your expected yield. For example, if you invested in 3M in the long run, you can select the 2 points on the price chart, and you see the annual average yield of 3M, including dividends, was 7.7%. That's about the broad stock market. But you see also that the stock price was volatile, although earnings were also a little bit volatile, but much less volatile than the stock price. And this is where valuation comes in. Imagine that you bought the stock somewhere here for $250 around. And then after you bought the stock, it peaked around 260, but then the stock price came back. And 1 year, 2 years, even 3 years, even after 3 years after buying the stock, you were still in the negatives. You had capital losses, and many people don't have the patience to wait until the stock bounces back, until the stock price really comes back. We would even have capital losses up to today if you bought here. And now the question is, was it just bad luck? you bought the stock here, or could you have already known that there's a high probability of correction when you bought the stock here? And my answer is yes, because you can calculate fair values of each stock, for example 3M, and if I show you the fair values based on reported earnings here, looks like that. And you see here, even if the black line, which corresponds to the stock price, is above the fair value, then the stock is overvalued. If the black line is below the green fair value line, then the stock looks undervalued. And you see here that the stock 3M looked clearly overvalued during our virtual buying time here. So the probability of a correction was already very high. And then comes even bad luck, or Corona. And Corona led to declining earnings. And you can say that, for example, this correction here, this is just normal correction which had nothing to do with the company itself, because okay, the earnings growth slowed down a little bit, but overall earnings were still growing, and this is mostly the aspect of fair valuation. So the guilty one was a stock market, or you as an investor when you made your purchase here. And then there was some bad luck, meaning that there was a decline in earnings, and because of that, the stock price from a fundamental point of view was a little bit less valuable, or the stock was a little bit less valuable because the company's earnings declined. Come back to this later. So in this decline of the stock price from 180 to 150, it's fair value decline. This part is due to the company itself because of Corona, but most of it was due to you buying the stock when it was overvalued. And this is what we try to avoid. We can also take other examples like Johnson & Johnson. I'm sure you know this company, pharma giant, Johnson & Johnson. You can type in the symbol here, and then you also see, first, it's a high quality stock because earnings, cash flows, dividends, anything grows. But you can also see that here we have some up and downs, more ups than downs, but we have also downs. Then you can also look at the earnings, and then you see that the stock was sometimes under and sometimes overvalued. And we have also our metrics, but I want to come back to this later, because I come back to it right now. We have reported earnings, we have adjusted earnings, we have operating cash flow, and we have dividends. And we have 4 different types of metrics, and we can always use these to calculate a respective fair value. I want to come back to 3M because I already played around with this, and I can explain it maybe better with the stock. So you see the 4 underlying metrics once more, and then the question is always which fair value to take. So we have these 4 values here, and sometimes they match, they are very close to each other, and sometimes they differ. If metrics are very close to each other, they confirm each other, because fair values are always estimates only. There are 2 possibilities to get an idea if the fair value is valid or not. First one is if the fair values are very close to each other, then they confirm each other. Second possibility, which is even more important, is to look at the real stock price and to verify if the calculated fair values, or if the stock price respected the calculated fair value in the course of time. In which course of time you can change that. So we can enlarge the display period, and you can take the mouse and just click the mouse button and now drag the period of time you want to get the calculation of the fair value, and then the fair value is calculated for all the time frame you selected. And this is also like some kind of back test, and now you see if the fair values were respected by the stock price or not. If they are respected, if the stock price matches more or less the fair values calculated, or if the stock price comes back after under or overvaluation. One thing I should explain maybe is how the fair values are calculated. Let's just concentrate on this one, for example. This is the fair value. And this fair value is based on the reported earnings. And always, if we select a period of time here, just as I explained, we calculate the average multiple. In this case, it's the price earnings because it's based on earnings. So we calculate the average price earnings, which is 18.4 from 2003 to the present. Here is stated 2024, but we don't know the future price earnings because we don't know the future stock price. Would be nice, but we did not implement this yet. So the average price earnings is 18.4, and now we simply calculate for each business year the fair value by multiplying the calculated average price earnings 18.4 with earnings for each year 18.4 multiplied by 3.02 for the year 2003, and then we have a fair value of 55.44 US dollar. Works simple like this, and this we do for each year, and then we get here these fair values. This is how it's calculated. And then we have the stock price here, and you see that it more or less matches, especially when the stock looks heavily over or undervalued. And now the most or very interesting aspect or question is, should I buy the stock right now, or is the stock cheap right now? Does it look cheap or does it look overvalued? So this is the most interesting time where I place the red dot. It's the present, it's where we are right now. So let's zoom in, and for example for 3M we see that the stock is slightly overvalued. So the stock regained from some of its losses. Now stock price is close to 200 US dollar, and the fair value based on estimates for the current business year based on reported earnings is 180 US dollar. And what you can expect right now for the rest of the year, for the remaining months, that there's a probability of a correction which is about 8%. It's not that much, but you shouldn't be surprised if the stock comes down a little bit. Of course, we never know when the stock market or when the stock price will come back to its fair value. If there will be any correction, because there's also the possibility that the stock price remains very high and that the stock price is not coming down but moving sidewards, and then this is also a possibility for if the company increases its earnings, then the stock price, that's the police or the fireman, or I don't know who's that. At least it's not my fault. They are not coming to this office. I hope they aren't. Okay, the stock price, if it's overvalued, there must not be a correction, but the stock price can also move sidewards. And if during this time the company increases its earnings, then the stock, the share of the company becomes more valuable, and then they match in the future. So this is also a possibility. You can also calculate your expected yield. You can connect the stock price with any calculated fair value, also for more calculated for fair values, a little bit more in the future, like this one, based on consensus estimates in the year 2024, then your expected annual yield would be 6.4%, which is a little bit less than the average in the long run we have seen at the very beginning, which was, if I remember well, 7.7, something like this. If this is not enough for you, if it means that the stock price is too expensive for you, then we have these helper lines here, and then you can, for example, say, okay, $200 is too expensive, but here about 180, this is where the fair value right now is. And if I would buy at this price, then my expected yield would be 9.4%, and this would be interesting enough for me to buy the stock. And then you can, for example, just enter here in the buy limit stock price, make $180, it's the correct currency. You can just save that, and you can also get an alert if the limit is breached. If you want, you can configure that. You have also other options. You can also say, okay, the price earnings, in my point of view, is too expensive, which was calculated for the stock, and you can adjust that. You can say, for example, okay, I think that 3M is more or less valuable. Let's say it's more valuable, and you make a price earnings of 20 here, and then you see that the fair value goes up because the multiplier went up and the fair values are higher than. Or you can just delete that, and then we have the default, which was calculated by selecting our time frame. Of course, you can also show the other fair values. We even have this fair value, which is calculated on the dividends or on the historic dividend yield. You see that right now. You see first that we have a big difference between these three calculated fair values and the fair value dividend. Here they were still very close to each other, and now here we have a spread. We also have a spread here between different fair values, but these fair values based on cash flows and earnings, they match very close in the future. So this is not really a problem. It's just because the underlying metrics, they didn't move completely in parallel. But what's the point about the difference between the fair value dividend and the fair value earnings and cash flow? It's that 3M, and I think we can see it, for example, here in the dividend turbo, they increased their dividends very dynamically starting in 2014. So here the growth was rather sluggish, and then the dividend growth here was very dynamic. And because of that, the fair value dividends, here it is, increased during this course of time. So just my monitor is just going black for a short period of time. Oh, yeah, I'm back. And because of that, we have this great difference here. And you shouldn't pay attention in this case on the fair value dividends. Or, well, let's say it in another way. If you're really a dividend investor and you're a dividend income investor, and dividends are really, really important for you, you can pay attention to that because it just tells you that the current dividend yield of 3% is more than you got on the average in the past. That's the message of the blue line here. But even if you're a dividend income investor, you should use these fair values to get an idea about your overall yield, which includes capital gains for sure. Okay, so this is the fair value calculation on dividend stocks cash. You can do this with any stock you want. We also have some explanations about the fair value calculation here. If you visit this undervalued stocks, you can even see this as guessed. It doesn't mean that these stocks are undervalued. It just shows you some stocks, and then you see the valuation here a little bit smaller than within the screen I just showed you, but just feel free to play around and always think that first it's about investing in quality stocks and second it's about valuation. Thanks for watching. See you next time and have a nice time and good investments. Bye.